Hey, it's Eric with Jazz Wealth Managers, where we don't just invest your dough, we like to educate you on your dough. Everybody hates paying taxes, so let's talk about some strategies that we work with for our clients with Jazz Wealth, where we really try to figure out how to not pay as much in taxes. So let's go over to the handy-dandy board. Let's talk about this for a minute and talk about some different things that we're seeing and things that you could potentially do. Now, the first one is one you've probably heard of, the HSA. It's an account we really like, but it's not for everybody. And the fact is you have to have a high deductible insurance policy when it comes to your health care to have the HSA. But if you have it, there's a really cool trick with this, because you can invest in the HSA, put the money in there, but then not actually use it for health care right this second. As long as you have the HSA and you're a part of that and you used personal money during the years that you were going through, you can actually go backwards. So you can say, hey, you know what? Back in 2023, let's fast forward and say you're in 2030. In 2023, I spent this money in healthcare, and now I want to reimburse myself. Completely legal option there for you to be able to do that. And it's an awesome way for you to then reimburse the healthcare expense. Now you can use that money tax-free however you wish for whatever that is. So it's a great way for the HSA to continue to grow as well. Instead of trying to just, put a little bit of money in, take it out, put a little bit in, take it out. So that's a good strategy there. The next one we want to talk about, this is a really cool one, and a lot of people love dividends. So as far as dividends go, you got to talk about qualified, if I can do that right, qualified dividends. So when it comes to qualified dividends, the nice thing here is that you can actually get tax-free money. And so the way this is going to work is if you are a single filer in 2023 and your total income, including the dividends, is under $44,200 or $625, that means that you can actually have tax-free money off of all of the qualified dividends. Now, what I mean by qualified dividends, this is a bit different than if you have a qualified dividend that's not in a pre-tax account or anything like that, in a retirement account. This is in a brokerage account. So if you're building out that dividend portfolio and you're just living off of the dividends, if you're a single filer, keep your income below $44,625, 2023, zero tax. Now, if you are married filing jointly, that's $89,250 is that threshold. Now, be careful though, because if you cross over that threshold, then immediately all of it is taxed at 15%. So that's a big one there. If your income actually rises above a certain threshold, then you're actually going to be taxed 20% on those qualified dividends. So a big difference there. The third one let's talk through here is one that I am sure you have all heard about, and that's a Roth IRA. But if you don't have one, start thinking about it. Now, I get the fact that some people now are high income earners and, they're maybe in a position where they say, you know what, I have a really high tax right this second. Maybe I don't want to do the Roth. That's one that you have to really calculate, look through. What's your total tax projected for the rest of your life? So if you were to just do the pre-tax account or the Roth conversions, things like that, it is nice the earlier you get these started, because you do have the opportunity to grow that money long-term, all tax-free, and in the retirement years, it's tax-free income. So that's the third one. The fourth one, the last one we'll talk about, is one that a lot of clients that I'm talking to nowadays are really talking through doing, especially in this housing market, and that's downsizing. And if you downsize, you take your primary residence and you have the opportunity, as long as you've kept that as your primary residence for the past 2 years, you avoid capital gains on that. If you make up to $250,000 as a single filer for 2023, or if you're married filing jointly, you can avoid the cap gains federal tax on that up to $500,000. So a large chunk there that you could potentially avoid, and that's more tax-free income to you. So just some food for thought for you to think about. If you haven't checked us out yet, be sure to go to jazzwealth.com if you'd like to invest, or you can schedule a call. We're here to chat. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.